Welcome to Study Time with Steve. This is the second time we're doing it this year. I think next year I want to do it a few more times. I think I'm going to boost it up to 4 times. But with me today, I have our guest, Diana Saylor. She's an executive wealth manager with the firm. So me and Diana have worked together now for probably about 15 years. And Diana, you've been here for 22?
23.
23. So I was close.
Close.
But yeah, so I know. But yeah, we've we work together. I think if you joined us last time, I was with Mike, and really this is just a discussion, something that we would kind of have in the office together. We'll show a few slides, and we can kind of go from there. Here is the legalese that everyone needs to read very carefully. But the one thing that I like to say on this one is that these views, whatever Diana and I say today, are only for Diana and I. They are not the views of everyone here at KWB. These views are just mine and Diana's. So let's go ahead and start it off with the first chart. The question that I've heard from the advisors, I don't speak to clients as often, but the question I hear from advisors that they're getting from clients a lot: why, if the market is back to near all-time highs, why is my portfolio not near the all-time high that it was? And the big reason for that is the other 40% of the portfolio. So stocks, yes, stocks have done well this year. Stocks up until a couple months ago were very near their all-time highs. But the other 40%, that bond side of things, is in the largest drawdown that we have seen in history. I don't see the number here. It's been 36 months since the bond market topped. And so the number that should be over on this other side, this is max drawdown during periods, is about 17%. So this is the largest in history. The last time we had anything above 10% was in the 70s and 80s. When Volcker was really trying to ramp up rates to fight inflation. And that's what the Fed has had to do this year as well. The last couple years is to fight inflation. They've raised rates from basically 0 all the way up to 5.5 now. So it's been a really dramatic raise in interest rates, and something we've never seen before. So Diana, myself, even Carrie and Bob have never seen a bond market like this. The good news is that moving forward, we should see, at least that 40% is going to have some yield attached to it. The 10-year is just below 5% today. So if you're in a 10-year bond, you're earning about 5% over the next 10 years. You'll make that 17% back over the next 3 to 4 years, which is good, and it's good for planning. But you've really had to go through a lot to get there. So what have you been hearing from your clients, Diana?
I get that question a lot. And I just wanted to bring up the fact that you had said we're in the longest drawn out, so 38 months. But what's interesting is the Fed only started raising rates in the beginning of 2022. So I think there's this misconception that rates really only move with whatever the Fed's doing. So rates were moving far ahead of that, but it was in anticipation of what the Fed was going to do. And it was a year and a half, Steve, that rates were moving all over the place in anticipation. Yeah. And so that's what was really interesting. There's just been a lot of volatility here. I think it's important to let everyone know what we've been doing in the portfolios this whole time. So we've just talked about how this has been a long, drawn out process. And so correct me if I'm wrong, but I think what we started to do at the beginning of 2022, in advance of the Fed raising rates, we started to go more short-term, higher quality with bonds, because for those that don't understand or know, we wanted to own bonds that weren't going to fluctuate as much. And so that's what we did at the beginning. And then at the end of 2022, we started to increase duration a little bit, just with the thought of maybe we're close to the end. So maybe just, Steve, if you could shed some light as to the specific portfolio changes that we made, late last year and even earlier this year, just in anticipation, or just while we've been going through this process, what have we done on the bond side to help offset some of these losses?
Well, part of it is not only on the bond side. So heading into 2022 and this year, we were overweight stocks because that issue of if rates are going to rise, like the risk was on both sides of the coin. So there was not much you could do to hide. So being overweight stocks, and stocks went down, let's say 20% last year. Well, bonds were down 15. It was basically there was nowhere to go last year. So you were right. We had a lot more short-term bonds at the beginning of last year. We rode that out for most of the year, and then beginning this year, as we see the Fed kind of starting to end their rate hiking cycle, we think it's better to be long-term. I actually read something a few days ago that said if you're in the longer-term bonds right now, there is a big disconnect between what would happen if rates go up 50 basis points and what happens if rates go down 50 basis points. So if rates go up 50 basis points from here on the long end of the curve, say from 5 to 5.5, you could expect to lose about 1%. And that's because rates are so much higher than they were previously. But if rates go down 50 basis points, you could expect to gain 11% in capital gains, not just from the yield. So there's a lot of bond math right now that suggests we need to extend duration. We need to be a little bit longer term in our bond positioning. And that's what we've done over the last few months, is get a little bit longer on our bond duration, so that if rates do start coming down, if the Fed says, hey, we're at the end of our tightening cycle, and then if the economy is not as robust as it has been over the last few years, they might start, pulling back on their rates, and that means rates might fall, which means we'll have a little bit of more capital gain on that bond side of the equation for portfolios. So I think, our positioning has shifted over the last couple of years, and I think we're in the right place. But again, the other thing to note is we are very, very high quality. Lots of treasuries, not a lot of high yield junk, not a lot of corporate bonds. We are sticking to, let's be in the safe haven asset on the bond side of things, so that if things go haywire on the stock side, we're going to have a lot of protection.
And I don't know that rates are going to go down anytime soon.
No.
I mean, we're pretty much at the end, I think, of this cycle, but maybe one more. We'll see.
No, my favorite thing the Fed doesn't even know what they're going to do
No.
with rates. So how could we know? The Fed has no clue until they get in that room together, and and they're just trying their best to have this soft landing that everybody keeps talking about. And so far they've done a pretty good job, but we'll see over the next 12 to 18 months how things shake out. Let's go on to the next slide, because the next one is talking about stocks and kind of where we've been and what you might see in the next 3 months. So this year we had a great year leading up to August and September. I believe we were up almost 20% on the S&P at one point. August was not a great month, and September was even worse. September was down just about 4.9%, just under 5%. But the good news is that I think we're through kind of the worst of it for this year. If you look at a lot of charts that show how the market reacts during the third year of a presidential cycle, the year after we had a 20% plus pullback, there's lots of different charts that show this year could be a very positive year. We had a definite pullback in August and September, but now we're heading into the fourth quarter. And if you look at this chart, it's showing that after a September that was down more than 3%, but the market is still up for the year to date, we have an average October of about 3.5% up, and a median of just about 5%, and a fourth quarter of over 9% return. So we're looking for the fourth quarter to be a big bounce back from those last 2 months. And October's already up about 2%. I just looked at it this morning. Now we're having a little bit of a pullback today. I think that has to do a lot with some of the charts that Diana's going to show in a little bit. So we'll talk about that later. But I still think that the fourth quarter is going to be a positive one because we have these dynamics that show, this is the type of year that the fourth quarter tends to do well.
And this year has been pretty textbook, I think. The first and second quarters, pretty good. September, here's the thing. I always tell clients, September is always terrible. I think since the 1940s, 50s, the average return for the S&P is -1. And so it kind of reminds me of a song. I don't know if you guys know the band, but Green Day is the band, and they have a song that says, "Wake me up when September ends." And I always think of that song because September is always terrible. And so I think if you have that mindset, you might expect it. But and generally, I think, Steve, we had talked about the fourth quarter is usually the best quarter of any year. Usually the fourth quarter. I think it's up like 80% of the time. So, we feel pretty confident about the end of the year, and they call it the Santa Claus rally. We want to be hopeful. So,
yeah, I mean, the other thing is, just think about how resilient the consumer has been in the United States this year. I think part of, we'll get to that. You have another chart that I looked at that I think shows why. I'm gonna kind of give my 2 cents on that. But the consumer's been so resilient this whole time that everyone, it seems like, has been predicting a recession. And that's the one thing that keeps me hopeful that this will continue to go, is that the consumer, everybody has jobs. Anybody who wants a job has it. And the consumer has just been a powerhouse. And so when 70% of your economy is driven by what the consumer is doing, it's a pretty big hill for the market to go down in the face of that. So I'm very positive on the fourth quarter. We'll see how things shake out with 2 wars now internationally. There's a lot going on. I think part of we'll get to it because you have some great charts on gas prices. I think that's one big thing that worries me, but we'll get to it. Let's go on to your first chart here, Diana, talking about mortgage rates and housing.
Yeah, so I get a lot of questions around housing and mortgage rates and whatnot. And so I wanted to show you guys a chart that is just from the end of September. So it shows the 15-year mortgage rate, 6.72, 30-year mortgage rate, 7.31. And actually, as of yesterday, when I looked at bank rate, the 30-year mortgage rate was 7.92 national average, and the 15-year was 7.18. So rates have really increased. And I reflect back to our mid-year economic outlook when I talked about housing as well during that time. And I had mentioned that many didn't think that mortgage rates would hit 8%. And sure enough, here we are. It did hit 8%. It's come down a little bit since then. You can also see on this chart the existing median sales price, 407,000, and that's down from 413 at the beginning of the year, end of last year. And then for new houses sold, the median is 430,000, which is actually right now the median home price nationally, 430,000. And so, what I get a lot is people will say, 8%, I remember when my mortgage was double digits. And, it's funny, well, that's not funny, but, when you think back to double digit mortgage rates, that was back in the early 80s. And so since then, from 1980, just throwing out a few statistics here, but since 1980, the home prices have increased 576%. And so, Steve, if you had to guess, what would the average home price be in the early 1980s? Just throw out a number.
I would say 50,000.
You're close. $75,000 in the early 1980s. So, it's not really apples to apples. And so what we're looking at is still a situation of massive unaffordability. So we're like at a 40-year, unaffordability situation here. And so that is concerning. I just looked at an article of we're at like a low of mortgage applications. So we're at the lowest point since 1995. I understand. So it's just, when are we going to see things improve, and we mentioned this also in the mid-year economic outlook, that because we have such low inventory with homes and there's still high demand, we just really don't see home prices coming down a lot. They have come down some since the beginning of the year, but we don't think there's going to be a crash or anything like that. So, if you think home prices are going to stay stable, really we should be more focused on rates. Where do we think they're headed? And so I think a lot of experts, or what I've read and what I've heard, a lot of them feel that next year we should feel some reprieve, that maybe by the end of next year, 2025, we might be in the 5.5-ish range.
The reason that I think the consumer has been so strong is because I think millennials, people Diana and my age, who haven't bought a house, then there's a lot of us out there. There's a lot of people who want to buy a house now in that, let's say 30 to 45 age group, who haven't been able to, who have been saving for that house, and they don't have the opportunity to buy it right now. Whether it's because they haven't saved enough, or the opportunity just isn't there. There's just not enough houses for them to buy. So I think the reason the consumer's been so strong is because those people in that age cohort who can't buy a house are just saying, you know what, I have this money, I'm going to spend a little bit more. That dynamic is shifting things a little bit, where some millennials are just saying, all right, well, if I'm not going to buy a house, I'll just rent. I'll have a little bit more disposable cash for now, and we'll see where things are in a year or two. So it's not all bad news, I guess, for people who want to buy a house, and for people who already own a house. And I think I mentioned this the last time we had study time, was that like 60% or plus of people who own a house own it outright. So there's not a lot of people out there who are actually making payments. And most of the people who are making payments have mortgages below 4%. So it's just that dichotomy of where there's so many people who want a house who can't get one, and all the people who have a house, have lots of disposable income because their mortgage payment's so low, or they don't have a mortgage payment. I think we're in a kind of a little bit of a sweet spot there. Now, as far as moving forward, what might happen to housing prices, I think I'm with Diana, where I don't see it falling because there is still so much demand for housing. But yeah, it's going to be an interesting thing to see what rates do. We're at the historically where interest rates are much lower than mortgage rates for some reason. I don't know if it's an affordability thing. What the reason? I want to say it's a demand thing. There's so much demand for houses that the interest rate has to go higher for the banks to do these loans. I'm very confused by it, and I'm interested to see where it'll go. I'm hoping Diana's right, that mortgage rates will fall, because we need to see some sort of a shift in that dynamic so that more people can get into homes. All right, let's go to the next one. This is the big one that I'm worried about. Housing is one, but the gas is a different animal for everyone.
Yes. So Steve, but my family and I just recently took our truck and trailer to Michigan and back, and this was about a month ago. And I had been hearing that oil prices were surging through, just articles or whatever. I didn't see prices going up, and I thought, that's odd. So if oil prices are surging, why are we not seeing it at the pump? And believe me, we were tracking all the way along what we were paying. And so I stumbled upon this article, and actually Mike showed it to me as well, is that there are reasons behind why we're not seeing it at the pump. But first, before I get into that, you can see there, as of the end of July, oil prices started to surge. And right now, I think they're about 91 a barrel, something like that. And the rationale behind that is that Russia and Saudi Arabia are cutting production. And so that has been more recent. Now, Steve, you mentioned the war, and there's concerns with maybe Iran getting involved and, any particular situation that could come from that. And so, there are many think that oil will probably go up to maybe $100 a barrel or close to that. But the next slide, Steve, if you want to show that, I wanted to pull up something that describes what we pay for in a gallon of gasoline and diesel. And so you can see they're pretty close as far as that goes. Now, we'll get into California here in a minute, but we wish. So gasoline on the left, you can see $3.60 a gallon, and then diesel on the right, $3.88 a gallon. So 14% and 15% for diesel go to taxes. 11% for gas is distribution and marketing, more of that for diesel, 19%. Refining, 25% for gasoline, 20% for diesel, and then just basic crude price, crude oil, 50% for gasoline and 47% for diesel. So that was interesting. And basically what the article showed or told us is that the reason why we're not seeing prices increase at the pump recently is that refining, it's the 20% that we're paying. So what's happening is the crack spreads or the refining spreads have plummeted since July. And you might ask, well, what is that? So basically, the crack spread is the difference, the price difference between crude and the products derived or refined from that oil. And so because it has plummeted, a lot of refiners are losing money. It's not a benefit for them to continue or do as much refining at this point. So we're seeing a little reprieve at the pumps. And so the other thing that's happening is we're entering in the winter season. So a lot of you may not know that winter, we get a different type of gas. It's a little bit cheaper. And so we're heading into the lower demand season. And so, prices may continue to come down. In California, I was interested to kind of see, why are we paying so much more? And so with California, of course, we have higher tax on gas and diesel. Also, we get a special blend. And so that has to do with emissions. And what was interesting that I read and saw is that with California, normally our winter gas comes in after Halloween, but they've escalated that. And so now we're already getting it. And so maybe prices will continue to go down. Futures are actually coming down for gas. And so, and the U.S. is in talks with Venezuela. There's a bunch of different things going on. But if gas prices could continue to stay flat or come down, Steve, you talked about the consumer, that could really be a tailwind for people or a benefit for people, especially with, higher cost of food or energy or what have you. And so that will just help the consumer even more.
Again, going back to my biggest concern is this. The problem with oil prices and gasoline prices, especially here in the United States, is that it not only affects companies, it affects the consumer. So that price of oil, that price of gasoline, it just translates to everyone. Whereas like if it's wheat or something, someone might buy less bread or do something else. You have to buy gas. Everybody needs it for multiple things. So the oil price issue is my main concern. We haven't seen much translate over from what's happening in Israel yet when it comes to oil. I agree that we're coming into a better season in terms of gas prices. Actually, like driving down the street on my way to work have fallen like 25 cents just in the last 2 days.
Right.
So I mean that's a nice little transition from my worry of, oh man, if we spike above, in California, it's hard to know because if we spike above $6 or $7, everywhere else in the country is getting it for 4, and it's like, California is California. So, but it is one of those things that I worry about. Like Diana said, we haven't seen that translate through. We're going into the winter season. I'm pretty positive that we won't see that, but it's the one thing that really keeps me, worried at night is like what might happen to oil prices, because it's just, there's no way around it for companies, for consumers, for everybody. And with that, that's the end of our kind of talk. If anybody has any questions, you can feel free to unmute yourself and go ahead and ask.
Hey, Steve, this is Dick.
Hey, Dick, how's it going?
Good. When we last met with you guys, you were making a move now from equities into bonds, kind of what you were talking about at the beginning, with the thinking that the rates probably would drop, for the bonds, but it sounds like you're still leaning that way, even though the discussion is that, they're not so sure that the interest rate's going to come down anytime soon. When last we spoke, it sounded like you were looking maybe even at the end of this quarter. So what are your thoughts there?
Go back to Diana's comment about when rates started to rise versus when the Fed actually started to raise interest rates. So long-term rates are less beholden to what the Fed actually does. So yes, we've seen rates kind of bounce around here, or right below 5. It's basically been between 5 and 4.6 or so. The longer rates have been bouncing around over the last few months. If bond traders, if the market starts to see that the Fed is going to lower rates, those rates will start to move before the Fed actually does anything. So you want to be in the longer term bonds before the Fed actually does things, because those are not beholden to what the Fed does. Only short-term rates are really beholden to what the Fed does. So we still believe that in the longer term that rates are going to come down, those longer term rates, and that's why we've positioned ourselves that way. It hasn't been the play yet, but again, going back to that bond math, you're not getting hurt as much as rates go up, and you want to be in those bonds when those rates go down, because if you're not, you're going to miss it. If you stay in a short-term bond right now, yes, you're getting 5, but even in the longer-term bond, you're getting 5 as well. Yes, you're moving around a little bit more as rates move around, but in the short-term bond, if rates go down, let's say the Fed goes from 5.5 or 5 to 4, they can do that pretty quickly. You don't get any benefit from that. There's no benefit in a short-term bond with the price, or with the price. You're only going to get less yield at that time. In a long-term bond, you're going to get price appreciation as yields come down, because there's that bond math of yields go down, prices go up. So you are going to get a little bit of appreciation plus the yield that you're getting. So you have to think of it and look at it a little bit from where might yields go from here, and we don't see a ton of upside. Now, we could bounce around here, which wouldn't be fun for anybody, but once we do see those rates fall, that's when you're going to get the big kick of capital gains appreciation that you wouldn't get in a short-term bond.
So then in clarifying, one of the things we could do is just put our money into Treasury and get 5% for 2 years or 10 years.
Correct. My big thing with buying individual bonds is I want to know, if I'm going to buy that, I want to know that on the other end I have a reason for having that money in that. So the reason you buy a bond fund is you're having lots of different exposures. You have, in the bond funds we're buying, yes, you're probably mostly in longer term treasuries, but you get some corporate, high quality corporate bonds, things like that. And the reason you want to extend that duration is that, let's say you buy that 2-year bond, you're getting whatever it is, 4.5, 5. At the end of that 2 years, if you don't have anything to do with that money, let's say rates for that 2 years are now at 2%. You got the 5 in the meantime, but you didn't get any appreciation along the way. And now when you go out to try to buy another bond, you can only get 2. So the reason to have longer term bonds is you get that capital appreciation, and you know, to have a bond fund versus just a bond is you get that capital appreciation if rates come down. That's very technical. That's a technical thing. That's, you know, that's the hard part about, you know, building a portfolio is what's the right difference between having short bonds, having long bonds. You know, building that is the hard part, because again, we don't know where rates are necessarily going to go, but a lot of it just comes back to the math of, if rates go up, I'm not getting hurt that much, but if rates go down, I'm really benefiting from it.
I do get that question a lot. You know, why don't we just take the whole bond side and just throw it in a treasury, or, you know, we're getting 5.5% or whatever. And it goes back to exactly what you said. It's just the return potential. And we're looking, rates are at a top and probably not for too long. So why not have a diversified portfolio of bonds? We're looking at things like that. We're looking at interest rates. We're looking at duration. We're looking at everything. And so we have much higher potential with the diversified bond portfolio.
Yeah, and the other thing is that, you know, how to diversify for stocks as well. So, you know, if you're in a portfolio that's 60% stocks and 40% bonds, you know, most of your risk is coming from the stock side. You know, it's not really coming from the bond side. It has over the last couple of years, but that was a once in a lifetime kind of event, you know, something we have never seen, the bond market has never seen before. So a lot of it comes back to, all right, if I have this 60% in stock that's risky, if I'm just in the short term bond and rates fall, I haven't done anything to protect. Yes, I got my 5%, but now it's 3. You know, what do I have to show for it other than the 5% I got short term, and now I'm only getting 3? At least if you're in the long term bond, you have that appreciation potential if rates were to fall. So it's not only just thinking about it from a, you know, what's going on right now, it's thinking about it from the whole portfolio.
Hey, Steve.
Hey, Jerry.
Hi. Yeah, this is Jerry. Hey, I just have kind of I'll start on the bond area because I have kind of a more generalized question for you guys looking at today's market, not today, but where we are today. Mm-hmm. You made a comment when you were talking about the drawdowns on the bonds that you said, you know, we've never seen this type of length before in the drawdown. I'm curious from the standpoint, the charts show a lot of historical points in time with different things happening, but we're sitting in an environment where we really don't have a terribly high unemployment. Mm-hmm. The market seems to be so focused on trying to control inflation, mm-hmm. that we're seeing so much volatility. I guess what I'm asking is, do you guys know of any other point in time where we were in a market like we have today, or how much of today's market is really kind of uncharted territory?
There are times you could look back to with higher inflation, and bonds are not where you want to be when inflation is rising. The thing is, you know, I believe that we're still in a falling inflationary environment, but we could be in a higher inflation environment than we have been in the last 12 years or so. So that sort of rhymes with the 70s, the early 70s late 70s, early 80s. But then, you know, what also happened in the 70s was oil prices, you know, the oil embargo, all of that stuff. So there's some things that rhyme with history, but they're not the same. So yes, we are in a completely new environment, but I also think that we're in a place where I don't think we'll ever see 12% or 13% interest rates. I think we're in a more stable economy than we were, 40, 50 years ago. And so there are going to be things that rhyme, but never are the same. So we're always dealing with a brand new environment, unfortunately, which is part of the reason why whenever you meet with an advisor, they're always going to say, stay the course, because
I agree with stay the course. It's just that nowadays I listen to reports every day on what earnings are, things like this. I hear a report that says, well, that should help the market. And when you look at the market, it goes the complete opposite direction.
Yeah.
Yes.
Well, again, that's why you always come back to the long term. And I showed this chart on the last one, but the longer you wait around, the more chance you have of succeeding. I said it in the last one. I always like to be right. And there's a quote from Ace Ventura, Pet Detective, where he says, "If I'm not back in 5 minutes, just wait longer." That's basically what I like to think about in the market. It's like, well, if I'm not right in the next 3 months, just wait another year and I'll be right, kind of a thing. So it's unfortunate, but I think what we try to do in the meantime is make those little tweaks where we see the advantages, and they might not come to fruition today, unfortunately, but in the next 18 months, being in longer term bonds, I think is the right place. Over the next 3 months or 6 months, that might not be correct, but over the longer term, I think that's correct. We've really trimmed our small cap positioning over the last few years. I think being in larger companies right now is the right thing to do, and that will shift as time goes on. But those are the types of things we're thinking about in the portfolios, as opposed to set it and forget it, where you could be in something forever. In the 2000s. Large cap stocks kind of went nowhere. But if you were diversified into international stocks, emerging market stocks, you had some appreciation. So it's those types of things that we're always thinking about, is what's the right thing for the next 2 years, 3 years, not necessarily, hey, we got to get it right every month of every year. We need to get it right over time.
Sure. Hey, one other question, and this is more probably for Diana. I'm just going to use the forum as an opportunity to ask. I recently received a new formatted LPL, what they call a quarterly statement. Mm-hmm. I'm just curious. I mean, are we going to see this? I'm not really up to speed on what LPL is doing. Is our monthly statements going to be replaced by just quarterly statements now? Do you know?
Hi, Jerry.
Hi.
So LPL, and actually there is a new format. I believe LPL has a new company that they're printing the statements through. And so they have a new facelift, a little bit different, but the information's the same as it was on the other previous statements. And yes, so LPL has changed the general mailing for statements to quarterly.
Okay.
And that's just, save paper. And, and we have our online portal. If any of you need help with that, let us know. We can sign you up there, or LPL Account View. You can access your statements on LPL Account View. But yes, they've changed their the delivery to quarterly.
Okay, that's fine. I was just curious because that's what I kind of thought they were doing.
Yeah.
Yes.
All right. Thanks, you guys.
Thanks, Jerry.
You're welcome.
You can always visit us at our website, KWB Wealth. We have our 2 offices. There's our phone number. And if you want to follow me on Twitter, it's KWB_Steve at KWB_Steve. Diana, thank you. It was a great conversation. Like I said, we love doing these because it's just like a conversation we would have here in the office. Thanks everybody for attending, and we'll see you around. Take care.
Bye, everyone.
Bye.